Welcome second year commerce students to exam tips and tricks channel. Today we will work out one more question from the model question paper that is based on dissolution of a partnership firm. We need to understand what is dissolution of partnership as well as dissolution of partnership firm. Dissolution of partnership, where the business is not terminated, economic relationship between the partners continues, closure of books does not require because the business is not terminated, court does not intervene because partnership is dissolved by mutual agreement, assets and liabilities are revalued and new balance sheet is prepared. In case of dissolution of a firm, the books of accounts are closed and the business of the firm also closed. Assets are sold out and liabilities are paid off. A firm can be dissolved by court's order. Economic relationship between the partners comes to an end. So that is about dissolution of a partnership firm. Today let's understand a problem based on this dissolution of a partnership firm. Two partners, Anita and Kavita, are partners sharing profits and losses equally. Their balance sheet also given in the question. So on the liabilities, the liabilities of the firm, bills payable, creditors, Anita's loan. Anita is the partner, partner's loan also given. Vanita is the third person. Vanita's loan, reserve fund, capitals given in the question. So liabilities of the firm, that has to be credited to realization account. So here we need to prepare realization account, partners capital account as well as bank account. So first we need to show the liabilities of the firm on the credit side. Debit side, assets of the firm, that has to be debited to realization account. So assets, that has to be sold out, liabilities, that must be paid off. Next, preparation of partners capital account, realization account has to be closed by the way of finding out the profit or loss on realization. Profit, that has to be credited to partners capital account, loss, that must be debited to partners capital account. Finally, preparation of bank account. Here liabilities, that has to be disclosed under credit side of realization account. Firm's liability, so bills payable, that must be credited, so that is one of the liability of the firm. Creditors is also one of the liability, 20,000. Anita's loan, partner's loan, that must be credited to bank account. So partner's loan, that must be credited to bank account. So credit side, that has to be disclosed as Anita's loan. Anita is one of the partner. So partner's loan, that has to be credited to bank account with 5,000. Next, Vanita's loan. Vanita is the third person. So external liability, that must be credited to realization account. Vanita's loan with rupees 5,000. Reserve fund, that has to be credited to partner's capital account, reserve fund. So 30,000, that must be divided equally, 1:1. 15,000 each, both partners. Vanita and Kavita's capitals given, that must be recorded as balance brought down with 50,000 each. So these are the entries under liability side. Bills payable, that must be credited to realization account. Creditors, that has to be credited. Anita's loan, that must be credited to bank account. Vanita's loan, Vanita is third person, so external liabilities, that must be credited to realization account. Reserve fund, it has to be divided equally, 1:1. Two partners capital, that must be recorded as balance brought down. Next, assets of the firm. So cash at bank, that must be recorded as balance brought down. So that is the opening cash balance, must be recorded as balance brought down. Then firm's assets, so debtors, that is one of the current assets. Firm's assets, that has to be disclosed under debit side. PBD, provision for bad debts, doubtful debts, that has to be credited to this realization account. Stock is current assets of the firm. Stock must be debited with 40,000. Investment is one of the asset, 20,000. Furniture, fixed asset, 14,000. Buildings, one of the fixed asset, 60,000. So these are the entries that has to be made. So cash at bank, it has to be recorded as opening balance, balance brought down on the debit side of bank account. Debtors, that is an asset. PBD, provision for bad debts or provision for doubtful debts, always it has to be credited to realization account. Stock, debit side. Investment, furniture, building. So these are the assets of the firm that has to be disclosed under debit side. Now adjustments given, so we need to make two entries for these adjustments. The assets of the firm that has been realized, it must be recorded as bank account. So the journal entry will be bank account data to realization account. In this realization account, it has to be credited with bank account. The assets are realized. Assets are sold out. Debtors, that has been realized for 25,600. That is the entry. Stock, that has been realized for 39,000. Buildings also being realized for rupees 66,000. Anita took over 50% of the investment. The value of investment is 20,000. So 50% of the investment, in the sense 10,000, one of the partner has taken over, and remaining investment, 10,000 of the investment, that has been realized at a gain of 20%. So investment, 50% of the investment, so that is 10,000 plus 20% gain, so that has been realized with 20% gain, that is 12,000. So these are the assets that has been realized. So bank account, debtors realized for 25,600, stock 39,000, building 66,000, investment 50% of the investment. Out of 20,000, 10%, 10,000 investment that is taken over by one of the partner, Anita, who is the partner, less 10%, and remaining investment 10,000 plus 20% gain, so 10,000 plus 20%, so that will be 12,000, and total amount is realized, that is 1,42,600. 1,42,600. So journal entry will be bank account data to realization account. So bank account, that must be debited with realization account. So it has to be debited as realization account. So assets realized 1,42,600. So it has to be recorded as assets realized, in the sense assets that has been sold out and the amount that has been realized, which is equal to 1,42,600. So we need to make two entries. One entry on the credit side of realization account, another entry debit side of bank account. Anita took over 50% of the investment. So if any of the partner who has taken over any assets, then the entry will be Anita's capital account. So inside the bracket, in investment taken over. So this is the entry. If a partner has paid a liability of the firm, then partner's capital account, that must be debited to realization account. If any assets taken over, then partner's capital account, that must be credited to realization account, and inside the bracket, assets taken over, that must be mentioned. Here 50% of the investment, less 10%. So 10,000, 50% of the investment will be 10,000 minus 10%, so that will be 9,000. So one more entry, Anita's capital account data to realization account. So Anita's capital account, that is 9,000, data to realization account. So this is the entry. So inside of the bracket, investment taken over. So this is the entry under debit side, because Anita has taken over this 50% of the investment. So two entries, one entry under credit side, another entry under debit side of partner's capital account. Next, furniture was taken over by Kavita. So Kavita is another partner. Kavita's capital account. Kavita's capital account. So furniture that has been taken over by Kavita. So Kavita's capital account data to realization account. Kavita's capital account. So the value of furniture is 12,000. That has to be recorded. So Kavita's capital account data to realization account. Under Kavita's column, 12,000. So realization account. So she has taken over furniture taken over. This is the entry. Two entries. One entry under credit side as Kavita's capital account. Another entry under debit side of partner's capital account as realization account. So these are the two entries. Then firm's liability. So there is a liability of the firm, bills payable, then creditors, then Vanita's loan. These are the liabilities of the firm. So that has to be paid off, even though if it is not specified in the problem, and that must be shown as these liabilities are paid off. So the entry will be bank account. So these liabilities are, firm has a liability of bills payable, then firm has a liability of creditors, then third person from whom the firm has taken loan, so it has to be paid off. So bills payable 6,000, then 20,000, 5,000. So that is the entry 31,000. So this is payment of liability, realization account, debtor to bank account. Bank account has to be credited with a realization account. So that is for payment of liabilities that must be paid off. So these are two entries, one entry on the debit side of realization account, another entry is credit side of bank account. So finally, Anita paid realization account. If the firm has paid realization account, then realization account has to be debited with bank account. Here, one of the partner who has paid realization expenses, so Anita has paid these realization account expenses. So Anita's capital account that has to be debited. So these realization expenses that is paid by her. So realization account debtor to Anita's capital account. Anita's capital account that has to be credited with a realization account. So that is the entry realization account. So for paying this realization expenses, Anita is being paid a remuneration by the firm, remuneration paid. So the amount is 2,600. So that is a payment made to Anita. So two entries, realization account debtor to Anita's capital account that has to be credited with realization account. So these are the entries, two entries that has to be made in case of adjustments. So finally, realization account, partner's capital account, finally bank account that has to be equal. So realization account that has to be totaled, and the total amount is 1,96,600. Write the same total under debit side also. So there is a profit on realization that must be transferred to partner's capital account. Partner's capital account. So there is a profit on realization that is 1,000. It must be divided equally. So Anita and Kavita, they are the equal partners. So it has to be divided equally, 500, 500 each. So profit on realization that must be transferred to credit side of partner's capital account. So realization account is closed. Now preparation of partner's capital account. Finally, bank account. So partner's capital account, where profit on realization that must be transferred to credit side of partner's capital account. So that is the next entry that must be made. So this entry will be realization account because profit has to be transferred to credit side. So this profit, both partners are entitled for the share of profit. So partner's capital account also has to be closed. So it has to be totaled 68,100 as well as 65,500. 68,100, 65,500. So there is a closing figure, balancing figure. It has to be recorded as bank account. So that is the balancing figure. So that is the difference. So 59,100 is the balancing figure. Again 53,500. This is a difference balancing figure. So partner's capital account also closed. Now closing of bank account. So bank account, that has to be equal. Debit side, that must be equal to credit side. So partner's capital account data to bank account. So bank account has to be credited with partner's capital account. So partners are Anita's capital account, Kavita's capital account, So that is 59,100 as 53,500. Finally, it has to be totaled. So total, that must be equal. Both debit total, that has to be equal to credit total. So the total will be bank account, that must be equal, and the total value is 1,48,600. 1,48,600 is the total value on the debit side as well as credit side. This is our bank account that can be closed in case of dissolution of a partnership firm. Thank you.